A lot of people have been thinking of a CN rail strike back in November as an example, and that really didn't weigh too heavily on the economy, despite the fact it lasted for over a week. But we've seen some of the timely data for freight shipments for the first half of February, and they've shown a big drop of over 10% in rail freight just in the first half. And that was only really as the rail blockades were gathering pace. So it was last week where CN Rail shut down its eastern network entirely. So freight probably fell even further. And we think that the grand total of all that is maybe an effect on GDP of 0.25, maybe 0.3%. And when you're talking about an economy that's been growing between 0 and 0.1% each month, that is really quite a big hit at the moment, and one the Bank of Canada won't really relish seeing. The good news, at least, is that now we've seen the rail blockade in Ontario come up. If we do see all of them come up, then freight could return to normal, and we will get an offsetting boost in March. But it's still some big disruption to the economy.
Let's take that and then add to it the uncertainty surrounding coronavirus. Is there a way right now to put some numbers behind what that could mean to the Canadian economy?
I think the direct hit so far is likely to be very small. So there's some economies that have obviously been quite effective, but Canada's direct links with them are quite small. China would be the largest one, but even visitors from China only make up 2% of total visitors to Canada. So really the disruption could come through supply chains or commodity prices. It's hard to gauge on supply chains, to be honest. We just don't know where all the individual components come from. And with commodity prices, oil prices in particular at least have held up relatively well. So we saw them come down, but at just above $50 per barrel for a WTI, we're not really talking about a price that's much different than at the start of December.
You have to wonder if Teck was looking at those commodity prices. They made headlines this week, a decision not to move ahead with a big project. What about that area, Stephen? I mean, it's kind of intangible to know what the net effect of companies making a decision not to do something ultimately is, but you get paid to do that. I mean, what would you say about that climate around investing in Canada's resources sector right now and how that impacts the economy?
Well, I think it's created a lot of headlines because obviously a very big project, the largest one Alberta would have ever seen, and would have been worth just the construction 1% of GDP.
Yeah.
But I think it's worth bearing in mind that there are already lots of other projects that already have regulatory approval but just aren't going ahead at the moment, and that's because the economics just aren't there. It isn't worth these companies investing all that money when we've got oil prices at a much lower level than they were, say, in 2014. The big thing for me that I need to see is these pipelines being built. So we've got Trans Mountain going through its regulatory procedures, but Enbridge's Line 3 is the next one that could come online as soon as 2021. And I think if that did come online, it would encourage some of the players in the sector to sort of expand their existing projects where they can and increase investment a little bit. But if we don't have that capacity to move the oil, then there's no way any of these companies are ever going to commit to these larger projects.
So if we put all of these stories together, you talked about the potential impact from blockades, challenges with getting new projects to market, uncertainty surrounding coronavirus. In a country where I believe the Bank of Canada has been looking at maybe growth for the year in the 1.5%, maybe a little bit more growth range, what are your own expectations for what we could see from the economy this year?
So our forecast for this year is 1.6%, which would be the same as last year by our estimates. Even though we'll feel some disruption in the first quarter from those rail blockades, we expect that to be made up in the second quarter because all that GDP should rebound again. So that shouldn't have an effect on the annual number. I think what the bank will be thinking of, though, is that we've had these rail blockades, the supply chain threat from the coronavirus, and issues in the oil sector. Those are all supply-side issues. So generally, when the bank loosens monetary policy, it's to try and get demand up. There's not so much it can do about these supply-side issues. So it doesn't necessarily warrant a response from the Bank of Canada. Where it could get interesting is if we see coronavirus fears spread a bit more, maybe to the North American continent being more pronounced, and then the bank may feel it needs to do something. But it's also worrying about the housing market at the moment. We also had the reduction in the stress test last week, or at least the announcement that that's coming. So I don't think the bank is going to be eager to press ahead with any policy changes anytime soon.
Cut rates. One market participant we spoke to earlier talked about how the markets in the U.S. are really trying to signal to the Fed that they would like to see more action. How would you explain the dynamics tied to the Canadian market? I mean, if the Bank of Canada doesn't want to necessarily feel pressured into having to do something like that, are they getting pressure, would you say, from the market to start thinking more about that?
To some degree. So market pricing is now pricing in essentially 50 basis points of cuts from the Bank of Canada in the next 15 months or so, so by the middle of 2021. So 2 rate cuts, essentially. But we were in a very similar position in the middle of last year when the economy started slowing, and the Bank of Canada didn't cut them. And to a degree, it's because the market is doing the bank's job for it. This reduction in market interest rates that we've seen with bond yields falling will feed through to even lower mortgage rates soon, and that will give the housing market and other areas of the economy a boost without the bank actually necessarily needing to cut interest rates itself.
Do we need to continue to see a healthy jobs market, which has been a positive for the Canadian economy, certainly justifies some of the increases that you see in home prices if there are people who are going to have jobs who can buy those homes or pay the mortgages associated with those homes. How important does that part of the equation end up being?
Yes, I think it's very, very important. I think the Bank of Canada is now going to approach the coronavirus risks and other risks in the same way that we approached the risk from the US-China trade war. It hinted many times last year that it was ready to cut policy rates if it needed to, but ultimately it didn't want to do that unless it actually saw the weakness in the data. So we did see a bit of a weakening of the labour market towards the end of last year, but then in January and December we saw employment rise again. So I think unless we have a renewed period of labour market weakness and weakness elsewhere in the data, the bank is just going to remain on the sidelines again.
What does all this mean for the Canadian dollar, which is in the 75-cent range right now against the US dollar? And, we've got an interesting dynamic at play where there has been so much interest in the US dollar that you have to factor that in as well, even though they have been, even the Fed has been quite accommodative, that there's, that safe haven status of the U.S. greenback. Given that perhaps we won't see any immediate cut by the Bank of Canada, that's the kind of thing that maybe plays to the favor of the Canadian dollar. But generally speaking, what's your outlook for the loonie?
So we're quite positive on it this year. We see it appreciating from about 7.5 at the moment to 0.79 by the end of the year, which is partly on our view that even though these coronavirus fears and disruption will weigh on the economy in the first half of the year, by the second half of the year we should see global growth recover again, oil prices pick up again, and ultimately markets will stop pricing in those rate cuts from the Bank of Canada.